Hello, I'm Valerie Okello, a research analyst at Capital A Investment Bank. I'll be providing you with a review for the Kenyan equities market for March 2025. The equity turnover over the last 3 months declined by 4.9% month on month and a decline of 27.7% year on year. The declining equity turnover suggests reduced trading activity as investors were not selling stocks and were optimistic about the earnings that were being released from the banking and insurance sectors. The companies that experienced the largest net foreign outflows were Safaricom, with outflows worth 337 million Kenya shillings, KCB Group with 270 million Kenya shillings, and Equity Group with 190 million Kenya shillings. Despite Safaricom, Equity, and KCB being among the top movers, bearish sentiment was observed as they had high foreign outflows, reflecting increased investor apathy amid rising global tariffs. Equity turnover over the last 3 months declined 4.9% month on month and 27.7% year on year. Declining equity turnover suggests reduced trading activity as investors were not selling stocks and optimistic about the earnings that were just being released from the banking and insurance sector. Foreign participation has drastically reduced, with buying and selling activity declining sharply compared to last year. This is due to global economic concerns such as the current US tariffs and policies. Among the top gainers, we saw Liberty Kenya Holdings emerging as the top gainer, driven by impressive fundamentals, doubling its full year profit to 14 million Kenya shillings compared to last year. We also saw East Africa Portland Cement being a top gainer as investors have spotted the attractive price to book ratio. Car in general was among the top losers. Investors anticipate negative earnings that are yet to be released, and HF Group also was a top loser. The earnings clocked below investor expectations. In the month of April, we expect the NSE to continue its bullish momentum, driven by anticipated monetary easing from the Central Bank of Kenya. A potential rate cut by the CBK will inject more liquidity into the economy, making equities more attractive compared to bonds. Lower interest rates typically reduce bond yields, prompting investors to shift towards stocks for better returns. Signing off for today, till next time.
Partner with CAIB to build a legacy that lasts.